Welcome to the Mutual Fund Show. I'm Neeraj Shah. A lot has happened in the last 7 days, including the budget, which has made some serious changes. And I know we've discussed them at length, but I always like it when I speak to Ashish Somaya, CEO of WTO Capital, for his views on what could happen to some of these changes. Of course, with the markets being what it is, it's lovely to get his view as well on what should one do between the categories, large cap, mid cap, small cap. I'm keeping the equity focus for the time being, maybe with a hint of arbitrage thrown in today because of the budget. But Ashish, great having you. Thanks for taking the time out.
Thank you. Thank you for inviting me.
The pleasure is ours. I want to start off straight off the bat with some taxation changes that happened, and I was made to understand that for gold funds, international funds, funds of funds with less than 65% in debt, the definition of specified mutual funds has changed. They'll not be taxed like debt anymore, and therefore the investor appetite as well as the product pipeline from AMCs into these categories might change. Would you concur, and what could the resultant impact be? Would love to hear from you.
Yes, Neeraj, so last year when the budget came, it was said that, there's a term introduced called specified mutual fund. And then it said that anything with less than 35% equity would be called a specified mutual fund. And there, whether it is short term, long term, it doesn't matter. Everything will be taxed at the individual's marginal rate of personal income tax rate. So since it was defined as anything with less than 35% in equity, it means that gold, global equity, a lot of those things, which obviously have less than 35% domestic equity, probably the idea was to tax fixed income mutual funds. But then the way it got defined, saying that anything less than 35% domestic equity, then other than fixed income funds, it ended up kind of looping in gold funds and international funds and everything into that category of specified funds, because by nature, they are also less than 35% in domestic equity. So kind of collateral damage for other categories of funds in the quest for taxing fixed income mutual funds. So this time around, the budget has kind of changed the definition of what that specified mutual fund is. And instead of defining it as less than 35% domestic equity, it has been defined saying that anything more than 65% in debt will be a specified mutual fund and hence taxed like a debt fund, meaning that short-term, long-term doesn't apply. All gains are to be treated like normal income and taxed at the personal income tax rate, which automatically means that gold funds and international funds and all, they kind of fall out of that category. So yes, the taxation for them has changed. I don't think it is. I have no reason to believe it will result in a plethora of launches because we already have a lot of these funds out there. It's just that their tax treatment is not as punitive as what it is for debt funds.
Okay. So as a CEO, would you believe if you didn't have a product within these categories, this enables you to go out and launch this category because investor appetite might be better post this budget, or no, not really?
No, so for us, determining whether we should be in a category or not would totally depend on what we think our competencies are. So we are most keen to launch global funds because we at WTO we do have the ability to manage global equity and global emerging markets and those categories. We already manage it outside the country, but we want to offer it to local investors. But currently, it's not the taxation; it's more got to do with the RBI's limits on mutual funds investing abroad.
Okay. The other quick thing, and I know it's. I'm not saying you are an equity house alone or a one-trick pony, but you guys are so deep into equities. I just wanted to still understand, by virtue of your experience, about whether this taxation changes make arbitrage funds a relatively unviable or not so attractive a proposition now versus what they were for people who wanted to save and for a targeted period of 6 months, 9 months, 11 months, what have you, because they were used very, very well or very in a big fashion until the budget was done for that purpose. Do you think that changes post-budget? I mean, do banks get a share or what have you? But does the attractiveness of arbitrage funds therefore come off? And if so, Is there a mutual fund product out there, Ashish, now, which could compete with the other non-mutual fund products out there for short-term targeted savings?
So just to clarify, you mean anything which would qualify as short-term capital gain? Because let's say, for example, arbitrage funds,
Yeah,
obviously they fall in the equity category, and anything less than 1 year is short-term.
yeah.
Previously, the tax was 15%, now it's 20%.
Yes, exactly.
Yeah, so I don't think, see, look, I mean, relatively, I mean, if you were to say that I put money into a fixed income fund and it gets fully taxed, or if I keep money in the bank, it gets fully taxed. Yes, compared to that arbitrage funds, within 1 year, it became long-term gain. So it was 10%, now it will be 12.5. Less than 1 year, short-term gain, so 15%, which will now be 20%. Now, I think it's just about relative comparisons. Yes, the trade-off or the gap has reduced, but I think arbitrage funds are still attractive. So I don't think that would change at all. Coming to your point about competing with traditional instruments, I think the category which would benefit the most is the way we run multi-asset funds. I mean, you know that a lot of multi-asset funds are clearly like equity-oriented funds. I'm not talking about them, but let's take an example out here. We manage a multi-asset fund which, say, on an average puts 20-25% in gold, on an average 25 to 30% in domestic equity, and the rest in fixed income. Now, what happens is that you're trying to create a product with low volatility and give reasonable hybrid kind of return, which is high single digit, low double digit kind of number, but with low volatility, because you are combining gold and equity, almost in similar proportions. So now these kind of funds benefit a lot because the holding period for it to qualify as a long-term gain, the holding period has gone from 3 years down to 2 years, and the tax is flat 12.5%. So if you ask me, funds which are conservatively structured and use equity, debt, gold, etc., where the holding period required to qualify as long term has come down from 3 years to 2 years, they are actually the ones which can effectively qualify with pure fixed income or with traditional. I mean, they can actually compete with pure fixed income or traditional instruments.
Got it. Okay. Now to the $1 million question, which is what should investors do at the current juncture? One, with the Nifty almost touching 25,000. I mean, 20.25 bips away from that. It almost should have touched it and come back. But be that as it may, with the way we've rallied, the valuations that we are at, etc., what should investors do? One, with the market per se, what's the house view? And two, your personal view, Ashish, about investing, staying invested or putting in fresh money, either of the cases, between a large cap fund versus maybe a mid cap fund or a flexi, which would probably house all the three at the current junction. What would you do with your monies?
So I'm not bearish, or I have no reason to believe that we are going to do very, very badly. But yes, definitely, market is always, there are always three things with which you can describe the market, and you will never be wrong if you use these three terms. One is that market in terms of valuations is mean reverting. Second is it's always cyclical, right? And it works on relative valuations. So these three things you will never go wrong. Now, let me just exemplify that. Clearly, if you see the market the way it has been, if you think that the market should go up, then it cannot just keep going up based on the few things that have worked, right? So if you say financials, IT, consumer, pharma, chemicals, you can clearly see in the last 3 to 6 months, the market has started to rotate a little bit. I mean, what has worked very well in the last 2 years, that still continues to grind up. But if you look at relative performance, then you can see that there is some sector rotation, and even when you speak about large cap, mid cap, small cap, you can clearly see that on very many days we have seen large cap outperforming small and mid cap. So that relative valuation and mean reversion is already starting to play out, and therein some hints should be there for people who are investing. It also, calls for people not to get very, very overawed, or not to get very, very drawn in by what worked very well in the last 2 years, and disregard what has underperformed in the last 2 years. So getting your portfolios a bit more centered. I suspect that in last couple of years, portfolios would have skewed in favor of thematics. You can see the kind of money flowing in. So portfolios would have got skewed in favor of thematics or in favor of small caps, micro caps, those kinds of things. From there, I think the portfolio needs to come back more closer to the market and more centered in terms of allocations. Second, I agree that you should be closer to the large cap, because if you see Nifty on a 5-year basis, while it has gone up a lot, but Nifty on a 5-year basis is practically in line with the earning growth. Correct. So the large cap is not something which is really stretched. I think there is scope in the market, but people need to get their portfolios a bit more centered. Second thing is, of course, what kind of return has been made in last 2-3 years. That is hard to imagine would go up. Also, in terms of triggers, now result season is obviously mixed. The budget is out of the way, not very positive, at least as far as capital markets are concerned. The triggers coming up are all related to US and US elections and US interest rates and stuff. So, for a while, we need to watch out for that. In the short term, I mean, next few days or weeks, market may be range bound or it may consolidate. And people should temper down their return expectations and also create some changes in the portfolio such that it comes back more in center rather than being stretched in any direction as far as sectors or market caps are concerned.
But I'll tell you what, from about circa 21,500, yeah, every second or third voice has said that return temptations should be tempered, and the markets have marched to 25,000. So the people who sat on the sidelines, if at all, are saying, hey, why is it that this is happening? Because the flow of money is so strong and the markets have continued to perform. Why is it that the markets will not do well?
So, look, we've seen, last 3-4 years has been very, very eventful. So what happens is that I mean, I was always thinking that market would inch up higher, and wherever I have the opportunity to communicate with our investors, intermediaries, even now I think it can inch up higher, but only with sector rotation and market cap rotation. So that is my first point. But the second point I want to tell you is that when the market is lower, you can try to make return on 100 rupees out of 100 rupees. But when the market is 24,000, the last mile or the latter half of the rally, you don't need to ride with the entire 100 rupees, right? So how much of the market you will ride with a full allocation versus at what stage of the market you're willing to ride with a slightly lower or more defensive allocation, I think that is the recalibration what we are really talking about. And also, last 2 years, market does get polarized from time to time. But if you see last 2 years, say, financial, IT, consumer discretionary, all this is 50-55%, or even pharma for that matter, or chemicals. All this stuff is between 50 to 60% of the total market. All of that has been laggard. Some other labels and themes have really been driving the market. So it's just about, I'm repeating myself, but it's just about making your portfolio a bit more well-balanced and centered so you can participate in the whatever next stage of the market rally is, and don't get painted into one corner of the market just because it did well in the last 2 years.
Okay, that's a fair point. That's a very fair point. Great. Ashish, one final question. And a lot of debate has come up of late about between Flexi and Multi, because there used to be a tint between the two, and now a lot of Flexi cap funds have mirrored large cap funds more than it being truly Flexi cap. I mean, I don't know what is truly Flexi cap, but critics mention that. So my question to you is this: between a Flexi and a Multi, is there a choice that you would make? I don't know if you have both the products in your portfolio. I know you have a Flexi cap, if I'm not wrong, but I would love to understand how you think about it.
So as a mutual fund CEO, I can't make choices. I have to have money in every 20% of my post-tax compensation has to get divided into every fund that we manage. So I don't make any of those choices. But yes, I do have a personal choice. Two caveats. One is I generally don't redeem based on market levels. So I'm perpetually invested into equity. And second is, 10, 20, 30% or even 40% down doesn't make me lose my sleep. So with those caveats in place, I'm not a big fan of Flexi cap. I always prefer multi-cap funds. The reason being that if you're a long-term investor who doesn't care about the volatility, then I think the alpha potential is more in the small cap and mid cap. And when a multi-cap fund, the regulator insists that you are minimum 25% small cap, minimum 25% mid cap, which means that a good stock picker with 50, 60, 70% in small and mid caps over the long period, it will outperform. Why do people talk about flexi cap? Because they think that the fund manager is going to be a macro guru and he will decide when to have more large cap, when to have more small cap, or when to have mid cap. I don't think those macro calls can be taken, and I don't think anybody can predict in advance that now this market cap will do better than that market cap, right? Yes, few minutes back we can ourselves catch ourselves chatting that I expect large cap to outperform because small cap went up a lot, or that's fine. That we can have that kind of assessment from time to time. But for a long-term investor to expect that a fund manager will predict every bend in the curve, I don't think it's going to happen. So I just think that you should be in a multi-cap fund and just fill it, shut it, forget it kind of thought process.
With all the caveats that Ashish Somaya put out, so please, when you hear this answer, hear the first part of that answer as well. It's very important. But Ashish Somaya, such a pleasure talking to you. Thanks for your patience today with us, and thanks for the insights.
Thank you. Nice talking to you. Thank you.
As always. And viewers, thanks for tuning in to this leg of the Mutual Fund Show.